Hello everyone, Dave Landry here from DaveLandry.com. This is Trading Simplified. So what are we talking about? Well, I'm going to follow up on my next 100 trade series. There's not a tremendous amount to talk about this week, but there is lessons. There's always lessons, of course, but I'll get through that fairly quickly. And this week I want to focus mostly on the trading psychology. So for Mind to Trade, I want to introduce you to the psychology and neurology before, during, and after the trade. As I'm putting this slide together, I'm thinking, you probably want to party with me, but it's vitally important that you understand this stuff. And if you don't, you will after you've been trading for a while. And I'll flesh that out in just a few seconds. Housekeeping, I do take requests. If I can fit them into this show, I will. And by the way, it is nice knowing what I'm going to cover ahead of time. So please send me your requests. You can send those to davelandry.com/contact. If I can't fit it into this show, I do a show usually every Thursday at 6 p.m. Central. And you can find that at davelandry.com/webinar. Register, as I say each week, even if the leak is old. There's my Twitter handle. Someday I need to do something about that. Every week I say that, right? If you want the slides from these presentations and all my other presentations combined, along with my books in PDF format and limited access to the members area, a market timing course, and just a plethora of stuff to keep you busy for a long time, go to davelandry.com/StockCharts. All right, let's talk about the mystery charts and the methodology in action, along with my next 100 trades. As I've been saying quite a bit, zero hindsight, everything will be either a mystery chart, which comes directly from my trading service, or will be a recommendation from my Facebook group. And as I've been saying quite a bit, warts and all, a representative sample, that just means I'm just showing something similar to what I recommended in the trading service. So it's not every single trade I'm taking. For instance, in some cases, I might take a trade across multiple accounts, and there's some other trades that I might take that weren't announced. But to avoid any hindsight, I'm going to announce every trade, or any what I show, I should say, has been announced ahead of time. So we have a reveal this week. DKNG was my pick last week, or one of my picks last week. Let's take a look at that. Now, the entry was a little bit higher when I first recommended it, but as the stock dropped, we dropped that entry down. So the entry is here after it began to drop. Stop was there. Initial profit target was up here. So let's take a look at what happened. Nothing. The stock continued to drop. So what did we do? Absolutely nothing. No capital was put into harm's way. And we've had quite a few of these lately, and I think that's a valuable lesson. Waiting for entries will often keep you out of a lot of trouble. Remember, as a trend follower, we want to make sure the trend has turned back into our direction before we hop in. Now, let's do a little update on EMBC. This was one I recommended a while back. And you can see there's the parameters down there. A buy at 30.50, stop at 26.50, IPT of 34.50. And as I showed recently, and you'll see the spreadsheet in a few minutes, I did get in a little late on this one, and I ended up getting out a little early, at least on half of my shares based on that spike. And you can see it also made a near miss. And by the way, this is where a little discretion comes in. I'm going to talk about following your trading plan in a little while. But every now and then, when it gets really close like this, a little discretion is necessary. And on a day like this, if you catch a wide range bar within a couple hours, you're up big. There's nothing wrong with locking in some profits on that. Anyway, once the initial profit target is hit, we bring that stop up to break even. In this case, because it hasn't been hit officially in the trading service, we just brought it up a little bit as the stock moved in our favor. Here's another one that we entered not too long ago. You can see there's the parameters down there. A buy at 26, stop at 18, initial profit target of 34. And in this case here, it did hit the initial profit target, which should be right here. And then we trailed the stop higher on the remainder. And so far, it's just kind of consolidating by trading sideways. But overall, it's a decent trade. Now, let's take a look at the open service. This is as of last night. Today is September 6, 2022. And you can see the VERV and the EMBC in there. And not too much excitement, but the VERV is doing okay. Open profits of 13.44, at least based on the service that was published on Friday night. And then the EMC, you can see a slight loss there. The ultimate goal, as I preach, is to catch these occasional home runs. You can see this one's up over 400%. This one also had a bunch of dividends along the way, which was pretty cool and kind of a rare thing for me because I'm trading these high growth, high momentum type of stocks, and usually they don't have a lot of dividends. But in a case like this actually was a value stock when I bought it, not because I didn't buy it because it was a value stock. I bought it because the momentum was there. And sometimes value can become momentum, and sometimes just the opposite can happen. But I'm not a value player. I only buy things that are going up. So how am I doing? Well, once again, not a whole lot to report here. So last week I had a loss of 133. And as I've said in recent shows, what I did was I started to focus more on the core methodology for this project. And the reason being is I want to catch that occasional home run. Maybe VERV will turn into a 400% gain, or maybe EMBC, or maybe the next mystery chart down the road will turn out to be pretty good. So not a whole lot of excitement there. This week, actually down a smidge. VERV is doing okay, but the EMBC has come in a little bit since the original trade. So as I've been saying each week, real quick, I need to be careful about the observation thing. I don't want to take small profits just so I can show you a profit each week. I need to be careful to make sure I'm actually following the methodology. And so far I've been okay, but I have been kind of tempted in some cases to take partial profits maybe a little too early. Now, discretion is okay, like the EMBC and the VERV, and both of those I had fairly quick profits fairly quickly, and I went ahead and took those. Now, as I've been saying quite a bit, one thing that this fleshes out is sometimes in trading, it's almost like Einstein's definition of insanity, and we are guilty every now and then of doing that, thinking that if we just keep doing the same thing, we'll have a different outcome. As a general statement, as long as you're following a core methodology, something that you've spent a lot of time working on, something that's conceptually correct, you'll be a little bit more of Churchill's definition of success, doing the same thing over and over and not losing any enthusiasm when things don't work out. And I think Churchill said going from one failure to another without any loss of enthusiasm. But this is a typical thing when it comes to trading. You have to decide whether or not you are the definition of insanity or you're doing the right thing and you just got to keep doing it. Now, again, one thing I've been saying quite a bit is the core methodology, which is trend following, doesn't work all the time, but it does work over time. And you'll absolutely print money when the market is going straight up, and you'll grind it out when the market is grinding sideways. Now, let's shift gears and talk about mind the trade, trading psychology. I wake up every morning and I do a lot of writing, and as I've said quite a bit, I do my morning pages. I know it's something that Dave Keller does and he's talked about before. And I did it many years ago, but I stopped for whatever reason, and then I read a book, or at least read a few pages of a book by Julia Cameron, and she talked about the importance of morning pages. And I think it's one of the best things you can do. And from those pages, I get a lot of writing about trading psychology, trading in general. And one thing I've been thinking about a lot lately, and I started working on a piece on this, or a chapter for a book, is the dilemmas and paradoxes of trading. And there are many. And one of them that I was thinking about recently is that you have to lose an S-ton trading to fully understand how important trading psychology is. However, you have to understand how important trading psychology is not to lose a shit ton trading. Let me start that over. So one of those paradoxes is you have to lose an S-ton trading to fully understand how important trading psychology is. And you also have to understand how important trading psychology is not to lose an S-ton trading. Now, I'm not suggesting you rush out and lose an S-ton trading. Quite the contrary. My point here is for you to study trading psychology as much as possible. Obviously, you will have to go out and make some mistakes and learn how to trade, but do that in a small way and focus 10 times more on yourself and understanding trading psychology as opposed to grail hunting. Just find something simple and stick with it. Not that I'm the grand poobah, but my stuff is fairly simple. If you've been following these shows, you should be able to follow along fairly easily. I'm a big fan of epiphanies, and it's not like you have these huge epiphanies with trading and understanding trading psychology. You have little ones that come along every now and then, and this definition is my favorite: a sudden intuitive perception or insight into the reality or essential meaning of something, usually initiated by some simple, homely, or commonplace occurrence or experience. And one thing I would recommend you do in trading is to accept these things that happen that might feel strange and just go do them and go through it and honor your stop and allow that stop to get taken out if it gets hit, and then maybe go and look at your stock picking to make sure you did the right thing, and I'll touch upon that in a few minutes. But realize that a lot of trading is unnatural, and as you learn more and more about trading psychology, I'm not going to say that it gets natural, but you begin to understand why it's unnatural and why you have to sort of power through the markets and power through following your plan. Anyway, Steenbarger once said, people lose money in the markets because the person who places the trade is very often not the same person who manages and closes the trade. Quite literally, another self has taken over, another mind. So what does he mean by that? Well, literally, there are two yous. There's a you going into the trade and a you coming out of the trade. It is often a different psychology at work between the two. Now, you come into a trade, you're all excited, you see a TKO or something, and you've studied this pattern carefully, and you like the pattern, you've got this beautiful looking setup. If memory serves, I think this was a real trade that actually worked out really, really nicely a few years back. And this is you before the trade. You're going to buy this stock, and you're all excited, and boy, you really think you've got something here. And then all of a sudden, it triggers, and then not a whole lot happens, and you actually start losing money during the trade. So all of a sudden, the excitement wanes, and then you go into kind of a fear mode. Now, one thing that I realized in another part of that kind of onion unfolding in small epiphanies is that there's a psychology at work, and then there's also a neurology at work. I'd recommend you read this book. It's a fairly easy read, even though it's on a bit of a complex subject of dopamine and neurology. But it's very worthwhile reading. It's called The Molecule of More. And you can go to davelandry.com/books-2-read for more books on trading and trading psychology and neurology that I'd recommend you read. Now, going into the trade, you're full of dopamine. You ever notice that the excitement of something is a lot better than that actual thing? You get all excited about something, and my wife and I recently bought a boat, and it's like the excitement of the boat is a lot better than actually owning the boat. And so far, I've been tearing down the boat to repair the boat, but that's just owning a boat. But anyway, so you before the trade, before I digress too far, you're full of dopamine and you're feeling pretty good and you're all excited about it. And that is brought on by the anticipation of pleasure, which could be a very, very powerful motivator. Now, once you're in the trade, it becomes more of a here and now, and then the chemicals serotonin, oxytocin, endorphins, and endocannabinoids began to take over. Now, before the trade, you can have optimism. In the trade, you might find yourself with hope. There's excitement, once again, the anticipation of making a lot of money. There might be boredom, and I see that's happened all the time. I recommend the stock. It triggers, it does a little bit right away, and then it doesn't do much for weeks and sometimes even months, but it doesn't stop out. I guarantee you most of the clients get bored with it and exit. And of course, usually that happens a day or two before it takes off. Obviously, going into trade, you're enthusiastic. You wouldn't go into a trade if you thought you would lose, right? You're happy. You're feeling good. You're looking forward to making some money. Once you're in the trade, you might experience fear. Again, before promise and then reality. So different parts of your brain are lighting different chemicals, different feelings. Obviously, before the trade, you know everything. This stock is in a great trend. It's got a trend knockout. Looks fantastic. And then what happened during the trade? Well, it begins to die out, and you don't know what's going to happen. You don't know if it's going to keep dying out. Should you get out early? Should you honor your stop and wait? What should you do? Well, you should follow your plan, but that's a lot easier said than done. So before the trade, you have a lot of logic, and then your emotions are going to take over during the trade. And this goes on, but I'll try not to bore you too much. I know, too late. Statistical, before trade, you could say, okay, if X, then Y, whereas during a trade, you might be a little bit more irrational. It's a little harder to see and think clearly. As I often say, it's a lot harder to see clearly when your head is in the washing machine. So there's certainty before the trade. I'm certain this stock is headed higher. I'm certain it's a setup. I'm certain that it's a good looking setup. And then, of course, as soon as you place the trade, you step into the unknown. That certainty becomes uncertainty. And again, the environment's not changing, and the environment is completely changing. So you're doing your nightly analysis, you're feeling pretty good, you're finding these great stocks, you're all excited. The next day, you trigger into them, and then everything immediately changes. Now, unless you find someone to manage your trade, you're going to have to embrace and understand the 2 U's. As I've said before, I knew a couple who traded, and the husband would put on the trades, and he had a bit of an ego, and he would say, yes, I find the trades, and I put on the trades. She cannot pick stocks and everything. She manages a trade, but I find the trades, and I put them on. Well, initially, I thought he was a bit more of the grand poobah and all this, but the more I thought about it, the management of the trade is much, much, much harder than putting it on. Now, there's a before, there's a during, and then, of course, there's also an after when it comes to trading. Now, let's talk about the bad. As I said earlier, there is an excitement and anticipation going into the trade, but there can be an extreme excitement and anticipation. You really have to play devil's advocate quite a bit before a trade, and that'll keep you out of a lot of trouble, and I'll touch upon that in just 1 second. During the trade, there's often an overreaction to reality, and let's say you're trading something like VERV. VERV bounces around several points a day, sometimes 4 or 5 points. And if you're watching it go up 4 points, you're getting pretty excited. And if you're watching it go down 5 points, you're getting a little bummed out and a little stressed out, or you might actually want to exit that trade early. Now, what's interesting is, and this is another one of those things, another little slice of the onion that keeps unfolding, is about 10 years ago, and that's when I started studying trading neurology. I know, you want to party with me, right? Once again. But one of the things I learned was you have twice the emotional reaction to a loss as you do to a gain. And the other thing to realize, too, is observations are going to give you that twice the negative reaction. There's been days where I'm really busy and something like the VERV will go up and down 5 points. And I won't even notice. And at the end of the day, it's up a few bucks. I'm like, oh, VERV went up a couple of bucks. And I feel okay about it. But if I'm sitting here watching it go up and down all day, it's going to create a negative feedback cycle because the negative observations are twice as powerful as the positive ones. Not to get too far off track. Imagine that, me getting sidetracked. Anyway, that's what creates a gambler's ruin, is you're constantly chasing that high. You make a little money and you feel okay about it, but then you lose some money and you feel really bad about that. And so you keep, every time you make a little money, you feel okay, and every time you lose some money, you feel really bad, and you end up chasing that high. Now, after the trade, from a negative perspective, you could end up with a hindsight bias or hubris. And the hindsight bias leads you to believe that what you know now, you would have known ahead of time. Now, in some cases, that might actually be true because you look at a stock and you say, boy, this really wasn't that great of a setup. But a lot of times you feel like if you do something more going into the trade, which you now know, then you wouldn't have taken that trade. So you've got to be really careful with the hindsight bias. And also, you can't get too full of yourself. The worst thing that can happen is you take a really crappy trade and you make money on it and you think that it was your skill. In that case, it might have been luck. And you also might take a trade and lose money, and you might be so full of yourself, you say, well, I just got unlucky on that one. Now, in some cases, you may have been unlucky, but you really need to do. So the first thing that you really need to think about if you're being prudent before the trade is the doctor's creed. First, do no harm. Primum non nocere. And I doubt if I said that right. But anyway, you get the idea. That's the Latin for that. Always realize that doing nothing is always an option. Now, that's another one of those paradoxes of trading. The only way you could ever lose money trading is to trade, right? But the only way you ever make money trading is to trade. So you have to trade to make money, and you also have to trade to lose money. And it happens, spelled with a silent SH. But you need to think in terms of first, do no harm. All those things I've talked about in recent weeks. Is there a greater fool? Am I the greater fool? Is this the best setup that I could find? Always weigh that against doing nothing. Right now, I kind of have an advantage in that I get to pay attention to what's going on in my Facebook group. And right now, there's not a whole lot happening in the markets, but I could see that a lot of people have some sort of, they want to take some action. And some of the setups aren't the best in the world, but I feel like they're looking at these setups just so there's something to do. But a lot of times there's nothing to do. And if you think about that, that's really the holy grail of trading, figuring out when not to trade. Now, you need to temper your expectations. Of course, you want a stock to take off, okay, after you get in it, of course. But you also have to realize that maybe it won't. And if you're risking a small amount of your account, if you get stopped out, so be it. Accept that going in. As I often say, acceptance is very important. So once again, ask yourself, is there a greater fool, and am I the greater fool? And as I've said ad nauseum recently, does the trade pass the transformer test? Long story endless, I worked at a plant that made transformers, and I would get frustrated every time I'd call accounting to get some answers on some programming that I was doing, because everybody else would answer the phone up there. And one day I'm like, why won't you just let the phone go to voicemail? It's very inefficient for me. And they said, well, what if one of our kids breaks a norm at school? And I said, well, what does that have to do with making transformers? Now, I was half kidding, obviously, but they were very upset about it. But it makes sense. So what does your trade, your thinking, your life have to do with your trades? What does your recent trades have to do with your trade? So I've covered this quite a bit in prior weeks. Go in and watch those presentations for a little bit more on that. But the bottom line is we're influenced by a lot of things that have absolutely nothing to do with trading before placing a trade. So before is vitally important. Now, during, you're just going to have to accept what happens. VERV goes up 4 or 5 points a day. It also goes down 4 or 5 points a day. And as I said a second ago, if you watch it go up 4 or 5 points and then go down 4 or 5 points, it's really going to stress you out. You're going to need discipline, and discipline in some cases is easier than you think, and a lot of times it's harder than you think. But the way it's easier than you think is you might just put in a stop and then go about your life. That is discipline. You get stopped out, you get stopped out. Now, one of the most important things you could ever do in trading, in addition to picking the best to begin with, is a brutally honest postmortem. And again, you have to be careful, the hindsight bias, but go in and look at the trade as if you were just seeing it for the first time. Was it really trending nicely? Was it really the best setup that you could find? And as you trade for a while, you'll reach a point where you say, what the hell was I thinking? That's okay. That means that you're getting better. And And that means that you recognize you traded something that was mediocre at best. Now, the other thing is work hard to separate luck from skill. I've been on projects before where I've recommended something and I got called out for it, and my answer was, well, it worked, didn't it? And it's like, nah. In hindsight, that probably wasn't the thing to say, because as I was called out on it, they said, well, you sure did pick up nickels in front of that bulldozer. But you need to work really hard to separate luck from skill. Andy Duke wrote a great book called Thinking in Bets. I would encourage you to read that. Don't expect it to be some sort of revelation, but it does get you thinking about whether or not you might have gotten lucky on a trade or it was skill. And the true enlightenment, again, comes when you, A, say, what the hell was I thinking? But also, if you go back and look at a trade, even if you made money and said, you know, I really shouldn't have taken that trade. Well, I'm just beginning to scratch the surface when it comes to before, during, and after the trade, and I'm going to flesh that out in a lot more detail in upcoming weeks. If you need to reach me, davelandry.com/contact. If you want a bunch of information, go to davelandry.com/StockCharts. Get to know me first. I want to thank everybody for watching, and may the trend be with you.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.